eye out on that. Axis Bank, L&T, M&M, TCS, a couple of other heavyweights that are trending in the green, and BPCL is your top gainer. Remember, crude prices continue to fall. On the downside, you have a couple of these tech names once again. So HCL Tech, Infosys, Tech Mahindra are all down. Infosys, by the way, is now down 16% this year. So it's been a big drubbing for Infosys in 2023. Apollo Hospitals, Dr. Reddy's, Wipro. So I think pharma and IT are under a bit of pressure. ONGC is also a tad bit soft. But the market is not doing anything. The good part is that the mid-cap index is holding up. So there's definitely buy on dips that's playing out over there. And plenty of stocks that, of course, Nigel will talk about. But names like Chola, Investments, etc. reacting well to their numbers. Bajaj Consumer also is up 8% post number. So I think it's more newsy, stock-specific reactions, but otherwise market is quiet.
Well, just take a look at Chola, Sonia. We had a bit of a cheat sheet that came in, but the street really likes those numbers. The stock is up closer around 7%, and they've crossed that AUM of 1 lakh crore. So clearly those numbers are getting a thumbs up. Petronet LNG, margins were weak out there. That stock opens up with a cut of around 2% odd. Tata Chemicals, well, that one as well, the numbers look pretty okay. There was some expansion in margins. So I think the street liked those set of numbers. Stock is up 2.5%. Aptis Housing out there, that stock as well in pre-open was up closer around 2% odd. Aavas Finance, though, Mr. Sushil Kumar, he's resigned as the MD, so that's a bit of a negative tick I think we're getting on Aavas Financiers. BEML Land, that's the demerged asset. It comes out of T2T. Now the circuit filter has moved to around 20% odd. So that's why that stock is up closer around 3%. Volumes as well picking up on that one. Sula Vineyards, management sounding confident about the FY24. 15% growth at least, some tapering off in terms of margins. So that one opens up in the green. And Sona BLW, well, valuation-wise, it's a little bit expensive. But the first tick, the street like that, stock up closer around 2%. And KEC margins still struggling. So I think that stock opened up with a cut of around 1.5%. KEC International down 2.5% as we speak. Prashant.
All right, Nigel, it's a absolutely flat kind of day. So open at least 12 points, 10 points, 18,100 is where the index finds itself at. Let's just have a look at the Nifty Bank as well, and the mid and the small cap indices. By the way, broader markets, the picture worsened. It was holding well in the green yesterday, and then towards close, it pretty much came back off. The mid-cap index is up about 1/3%. They've been doing better than what large caps have been doing. Just sort of taking note of what's happening there. I mean, it's been a market about so many stocks which are moving around, and I think that is absolutely unchanged with what we are seeing today as well. We'll get to more names and more stocks in terms of what is moving. I think some of the bigger ones we've highlighted. So let's welcome in Sanjeev Prasad, Managing Director and Co-Head at Kotak Institutional Equities. He's joining in to take some questions. Sanjeev, great to have you with us here. Thank you very much for your time. In your strategy notes over the last year or so, one of the things you've always spoken about is the risk-free rate in the US and where it is, and if it stays there, what can it do? We are coming out of a Fed meeting last night where by all indications, or at least the indications from the Fed, is that we are closer, if not done with this rate hiking cycle. How does that change things broadly, top down, for a market like India?
Not much, I would say. See, I think this is pretty much priced in now that we are at peak interest rates as far as both India and US are concerned. Inflation has thankfully, looks like it has peaked in most of the developed markets, as also in India. So the chances of further rate hikes looks somewhat low now, unless until something goes dramatically wrong with inflation, which we are not expecting to at this point in time. But yeah, so interest rates are peaked. Having said that, if you compare this with where we were a year back, and also look at what could be interest rates, let's say a year later. My best sense would be we're not going back to zero for sure as far as global interest rates are concerned, which was a norm pretty much after the global financial crisis from 2008. You have had pretty much zero interest rates in most of the developed market. I would assume that nominal interest rates will settle somewhere above long-term inflation, maybe 2 to 3%. That's probably the longer-term inflation one should assume. Which means you're looking at a policy rate which could be well north of 2.5%, 3%, somewhere in that range. The more important thing is, if I compare interest rates with where they were a year back and a year later, effectively we have gone from 0 to, let's say, 3 kind of a number, which means your risk-free rate is maybe higher, your WACC is higher, your cost of equity has to be naturally higher, which means multiples have to be logically lower. Well, to that, if you add also the disruption risk which you are seeing across sectors and stocks, I would assume that you have to start pricing in somewhat lower multiples for markets going forward.
All right, the market, by the way, is handsomely rewarding good numbers. So Chola investment is now up 9%. It's at a fresh high. It's had a really smooth run this year. I mean, it's up almost 35% in 2023. So big thumbs up over there. ABB is also at a fresh 52-week high, and the street definitely likes those numbers. So the stock is up about, I think, 2% ABB, and there's more traction there. Sanjeev, hi, good morning. So this entire financial piece, right, has done pretty well, whether it's banks, whether it's NBFCs, I mean, ICICI Bank, Axis, now Chola. Has the time come, or, I mean, is it a good time to sort of be raising your allocations in this space?
I think most people have already overweight the sector. We have been pretty positive on this for some time now. In the relative context, the sector still looks okay. So even if you were, let's say, sitting underweight or have missed the bus until now, I still think it's not that late to get into the financial space. Valuations are still very, very reasonable for most of the banks and NBFCs. In fact, if you look at most of the banks are trading below 2 times price to book. Most of the NBFCs, if you exclude things like Mahindra Finance or Chola, most of them are in the region of less than 1.5 times 12-month forward book. And if you look at most of the banks will now probably do about 13 to 17% ROE. Most of the NBFCs are also in that range now. So quite okay from a valuation standpoint. Plus, as of now, we are not seeing any real challenges on either credit quality or on credit growth. The other things will slow down a little bit going forward. But I think in the context of reasonable visibility on the compounding the book, valuations are fairly attractive.
All right. Hi, Sanjeev. Good morning. Sanjeev, when we spoke a while back, you had said that you were cautious on 2 spaces. One was the IT space. And, that's pretty much played out because the results have been disappointing and lack of triggers is a bit of a worry out there. Have you changed your stance or do you continue to remain cautious on IT? And also autos, you said that you're a little bit cautious even on that space, barring, say, tractors as a segment. You maintain that cautious view as well?
Yeah, pretty much. So IT is more of a, let's say, a 6 to 9 months call. We still have to see, what is the extent of slowdown in the US. As of now, the US economy is still doing very well. The US Fed has signaled for now a pause. But I think the market is probably getting it wrong in the sense that it is assuming that you will see a series of rate cuts, by the Fed starting from the September policy meeting, and very quickly, within a year's time, we'll go to about 4% policy rate. I don't think that's going to happen. I suppose the US Fed will have to keep rates at current, peak levels for an extended period of time to ensure you see a proper slowdown in the economy. So now, if you look at any of the macroeconomic parameters in the US, barring the housing market, everything else is still doing very, very well, whether it is services sector, look at private earnings growth, you look at core inflation, and labor market conditions, all very, very strong for now. So I think we still need, a period of high interest rates for the US economy to slow down, which clearly one would call the default IT names. As far as the auto space is concerned, we have seen some bounce back in the stocks linked to lower commodity prices. But I think the space is so much ripe for disruption in the next 2 to 4 years. I think the returns of the companies are way too high. They will get eroded over a period of time as we see more competition going forward. So, yeah, I would be extremely careful of the kind of multiples people are willing to give to the auto names currently.
What about the other sort of ex-auto consumer space, Sanjeev? Are we still playing too much for what we're seeing on the ground?
Yeah, in the short term, we're clearly not seeing any recovery for now. The problem seems to be affordability. You've seen massive price increases in the last 4 years now. And the compounded effect of that is, in the range of 40 to 50% higher than where they were before COVID. which means things have become unaffordable for a section of the population, and ultimately affordability matters for for volume growth, and that is where the struggle is. Hopefully, prices remain now stable given input prices have stabilized. Another 1 year of earnings, wage growth. Hopefully, things start becoming more affordable. So, but I think this is still a 2 to 4 quarter phenomenon. I think consumer staples will probably start recovering ahead of consumer discretionary. And the medium-term challenges still remain. If you look at consumer durables, building materials, construction materials, you will start seeing a lot of changes in the way these products are sold. So the multiples will probably not hold in that kind of scenario. So disruption risk is very, very real in the sector too.
We are heading into a discussion with the management of Titan. So I just wanted your thoughts before we wrap this discussion with you. A very strong jewelry performance for Titan. And, this has been a consistent compounder over the years. And the management, despite all the challenges in the industry or in the economy right now, has reiterated that 20% growth is what they're going to be doing. As an investor, does that make you comfortable? How are you feeling about this space and the stock in general?
No, we are big fans of Titan. It's been there in the model portfolio for some time now. Even though the stock a little expensive at a 60 times 12-month forward basis, if you adjust for value of some of the other businesses for more like 55 times or so, but it's still on the higher side. But having said that, it's a fantastic company. It will continue to compound earnings at around 18 to 20% for a reasonably long period of time. And I won't put past its management to deliver some surprises on some of the newer categories going forward, because they clearly have a lot of skills in execution, implementation, etc. And I think the geographical expansion into some of the developed markets, plus in South India, that seems to be the next big trigger for the stock, apart from whatever normal growth you're going to see in the jewelry segment.
Sanjay, final question before we let you go. New age companies, we briefly discussed the last time around as well. Now, besides the price correction, you have interest rates as well could have peaked out, which helps their cause. What's your view on them? Some of these businesses looking interesting. You want to give us a hint on which one?
Yeah, I think so. I think at least Zomato is starting to look a little bit more interesting because anyway, it's a play market now. And hopefully, you will start seeing more sensible competition over there. So if that happens, I don't think it is too difficult for these companies to move towards profitability going forward. In the sense, if you look at Zomato, for example, the average order value of about 400 rupees, it's not too difficult, to build in some, extra delivery charges of 2, 4, 5 rupees, which can really improve the profitability of the business going forward. In the sense, given the fact that you only have a 2-play market, the market potential is fairly large. So with some moderate growth, you really don't need to spend that much on capital now. I think the path to profitability looks reasonably good over there. Other segments, we are actually quite okay with most of the names now, given the fact that valuations have come off. And at least the focus of the management has now shifted, to profitability. I think that's a big change, I would say.
All right, Sanjeev, thanks a lot for all of your thoughts. Appreciate them and have a great day. Thanks for joining us on CNBC TV18. By the way, for the market, it's picking up actually. So this buy on dips is something that's working for now. The Nifty is in the green. The mid caps are up about 75 odd points. And Titan is one of the stocks on our radar. In line set of numbers, and the revenue beat was pretty much led by sales of gold ingots worth over 1,055 crores. So the jewelry business has done very well. And there was a mild miss in margins, but nothing really to complain. Ashok Sonthalia, the Chief Financial Officer at Titan, joins us now to talk about that. Mr. Sonthalia, good morning, and thank you for joining us on CNBC TV18. I want to understand, the jewelry business, despite all the challenges, has been growing very well. And I remember you telling us that you're gaining a large part of the unorganized market share as well. After COVID, there's, that big shift that has happened from unorganized to organized, so that you're a beneficiary of that. But in FY24, what kind of realistic growth do you see for the jewelry business, and what could the market share be?
So FY24 started initially with the gold price, volatility and spike. The initial 2 weeks of April were slightly soft, but as the festive Akshaya Tritiya started coming in, we have seen consumer coming out in big number and making good purchase. On jewelry, several things are working for us. Apart from the major flagship brand Tanishq, Mia is doing extremely well. CaratLane is doing well. Our international foray in jewelry is ramping up extremely well. So we are very, very hopeful and positive about overall FY24 performance, and in line with whatever we talked about our long-term goal. If you remember in the last annual investor meeting, we have talked about 2.5 times in 5 years. I think we are on track of that.
All right. Hi, good morning, Mr. Santalia. Well, the stock is up with a gain of around 1% odd, so the street is considering whatever kind of pressures is one-off, and they're looking ahead. Give us a couple of numbers on the jewelry business. We have the EBIT margins. You're guiding for around 12.5 to around 13%. But what kind of revenue growth are you looking at? Point number one. And point number two, studded share has moved to northward of around 30%. But it's still not at those levels of high 30s. Where do you see this number stabilizing? So revenue growth as well as studded share. Go ahead.
So, if you really look at our FY27 ambition, and when we say we are on track to kind of deliver that, it is definitely high teen number we are talking about in jewelry segment overall, including our overseas foray. As far as margins are concerned, we have been talking about 12 to 13% is a reasonable operating profit band. And if we are kind of giving growth a priority and delivering at this level of margin in spite of whatever competitive intensity is there in the domestic market, I think it would be worth pursuing that kind of operating philosophy, that growth at a stable margin. As far as your studded question is concerned, while it is always good for us from the margin perspective to have higher studded mix in the overall thing, but we run all these segments pretty independently. There are teams, there are strategies, there are tactics to keep growing them. And generally, then these are outcome, but we would certainly, the focus, certain strategy is around high value studded segment. The whole premiumization strategy and the story in India is giving good traction to studded market. And we kind of leading from front.
What numbers, sir? What numbers should we work with as a range from studded?
Don't know actually, Nigel and Prashant and Sonia, we don't know that what number we will finally end up with.
Okay. I think in February when you had spoken with us, Mr. Santalia, good morning, you'd said that it should go to 30%, but no timeline. I mean, eventually the aim is to get it to about a third of the overall business. I just want to come back to that margin point, Mr. Santalia. So the guidance is there. The FY23 margins were about 13.7. What is the, you commented on some commission structure change with franchisees. Would that not lead to a boost to margins? Or that is a one-off thing and not kind of structural in nature?
So 13.7% we talked about, Prashant, that it has one-off in FY23, some gains sitting on our decision to buy diamond in advance, and after that diamond prices really went up, so we were sitting on a stock which was slightly lower cost and we were getting that gain. Now that has got normalized since Q4, and now the buying strategy has got normalized. So studded segment has returned back to the normal margin. We had some custom duty related gain also, that was also one-off. So 12 to 13% sits there, that, if you adjust 13.7, then actually 12.7 was the normalized number for the. So that is where we are talking about 12 to 13%.
No, and what about the rejig in franchise commission?
Yeah, so I was coming to that. I think, this is a pretty operational decision. The last time when we kind of did some adjustment in this was about 12, 15 years back. And since then, our product portfolio, the markets, everything has gone tremendous change. And this adjustment which we undertook recently was just to align company objective, which categories which we want to pursue, which we want to grow, and is the terms of trades are also aligned to that and kind of supporting. At the end of it, there will be people who will be gaining out of this also, who are able to sell those categories as we want. And there might be a minor, but overall, if you look at in the retail sector, Tanishq jewelry franchisees get one of the finest return, one of the best return in the retail sector. They are just not complaining. They are eager to even come to us and even open more franchisees with us.
Franchisees, okay. So that's on the jewelry side. I wanted to understand a little more about the watches and wearables growth as well. What is a sustainable growth that you can look at? And I think earlier you had made some comments about how you're looking to double the revenues in watches and wearables over the next 3 years, and the target is 10,000 crores of revenues. Are you on track to do that?
We are certainly, and we are very enthused. This time we crossed the 5,000 crore milestone, which was an important milestone for the division. And the wearable market in India is exploding. And as I have talked to you earlier also, that the initial 2-3 years we didn't play that well, but for last 1 year we are really playing from front foot. We have the team, we have the products, we have our supply chain. We have our R&D centers around that working, innovation centers working very nicely. So I think, and now we are a recognized player. IDC ranks us, I think, 5th in the market. So that's a exploding segment. Fortunately for analog also, the premium journey is working very well, and we are progressing on that. Our international brands, the Titan premium brands are doing extremely well. Some minor challenges at the entry level of Sonata and low price fast track analog watch. Fast track smart is doing again extremely well, but fast track analog not doing that well. The growth are softer. So, analog watch has its own trajectory on the premium side of it. Wearable has its explosive trajectory.
So, Mr. Santhalia, Sure. Just coming back to the numbers, I mean, Nigel very helpfully tells me that the watches and wearables segment by the end of FY23, I think did about 3,300 crores. You spoke about a 5,000 crore target. I assume that is by the end of FY24. And then when do you think you can achieve?
So Sonia, sorry to interrupt. There is a consumer price. 10,000 crore was a consumer price target. 5,000 crore we did in FY23. We crossed 5,000 as far as consumer price is concerned. But when we recognize the revenue in our books, then all those discounts are taken away from that number.
So what would the revenue, what would the revenues be? Because I think for our shareholders, right, or for your shareholders and our viewers, generally revenue estimates are looked at. So 3,300 crores is the base at which we are working with in FY23. So what are we looking at in FY24 and 25?
So you should also look at 10,000 target is the customer price target. Equivalent revenue target would be 6,100, 6,200 crore. So from that point of view, 3,300 crore is well on target to achieve that.
When do you go to the 6,100, sir?
That is FY26.
By 26. All right. Let's get a couple of other details on the smaller parts of your business. First on CaratLane, as you said, growth there is very, very good. You have 72% stake. Any plans on hiking stake out there, if you could tell us? And also, on your eyewear business, which is growing quite well, last year you grew by around 30%. Any plans of unlocking some value? Because, the street is quite excited. Now we have a couple of brokerages as well that are giving a value to this business. On both these two, CaratLane, will you hike stake? And will you unlock value in the eyewear business?
So CaratLane, yes, you are right, is doing extremely well and growth trajectory, and they are also expanding their retail network quite aggressively, because we have found that the whole digital and retail omni combination works best, and that is what they are pursuing. We are pursuing that strategy in other parts of our businesses also, but CaratLane has been demonstrating that pretty well. As far as the stake increase is concerned, I think these are decisions which cannot be commented on, unless the boards and the partners have come to some understanding, and we are obliged to then inform.
But Mr. Santhalia,
guys through stock exchange rather than commenting on this channel, right?
Mr. Santhalia, sorry for coming in, but is there a possibility that you go ahead and increase stake in this year? And also, if you could quickly comment about unlocking value in the eyewear business, which is growing very, very well.
So eyewear business is doing well. We have been talking about they have sorted out their channel strategy, their supply chain, their profitability. They are pursuing growth. They had a very good network expansion. They added about 138 stores. We have been talking about 1,000 stores. So I think they will be reaching 1,000 store milestone during next 6-7 months. That's my guess is they are already at 910-12 stores as we speak. I think eye care has a huge opportunity in front of them. And we don't have any plan to kind of take it out and monetize, rather keep it inside and then help increase value of overall Titan company. There is no plan to, separately monetize eye care business.
Okay, all right, Mr. Sonthalia, thanks so much for stopping by and giving us, all of those details. Wishing you all the best for FY24. But let's focus on the stock of this moment. Well, Cholamandalam investment, the stock is buzzing. Abhishek told us earlier that these numbers are very, very good. The loan growth is at around 27-quarter high. The asset quality has improved, while they've also clocked the highest ever operating profit. Mr. Arul Selvan Dinesh, the president of the company, joins us on the show. Hi, sir. Morning, and congratulations on a solid showing. The street has given it a thumbs up, despite you giving a bit of a cheat sheet even earlier. So it's come as a pleasant surprise. Give us a couple of numbers first. Let's get that out of the way. The AUM now has clocked more than 1 lakh crore. What kind of a growth can you see in terms of AUM for this year? And out of that AUM, currently new business I think is around 9%. Where does that number head to in FY24?
The AUM growth should be, in the range of around 20%, 20-25%. I would put it there, because the base is larger now, and which we need to work on this year's growth. The new businesses over period will be in the range of around 15% share of the overall AUM. This is again the similar numbers which we spoke earlier.
20 to 22% AUM growth. I mean, I think last in February when you were with us, you'd given us an estimate of between 22 to 23%. So round about there.
Yeah.
Mr. Selvan, good morning. Could you talk to us about these individual businesses? Where are you seeing the maximum traction? I mean, across the board, when we look at vehicle finance disbursements growth of 56%, I'm talking about full year numbers here. Loan against property, home loans, new businesses. Where are you seeing the maximum traction? What will lead growth in FY24?
See, vehicle finance will have still, in an absolute terms, it will have the largest growth, because it's got a good base, and it has got we have spread across geography and over the whole of India. We have this spread, and it has got multiple sub products under it, so it can sustain, differential growth rates across their sub products. The LAP and home loan are areas where we have now spreading our wings on other parts of the country, where our focus had been earlier in the case of LAP, south and north, and now we are spreading into west and east. And the home loan, we had been doing more of south and west, and now we are spreading into north and east. So these, again, from a geographical expansion perspective, would bring in more traction on the disbursements. But since the base is low, they will, in absolute terms, they will be lower than the vehicle finance, but in percentage terms, they will be higher. The new businesses, of course, have got very smaller base, so their growth will look reasonably faster as percentage terms, but again, from an absolute value, they will be short of the vehicle finance numbers. So I would overall put that is the whole point of the strategy we have adopted, to have multiple products so that we could sustain the overall growth irrespective of cycles and different product segments.
Sure, got that. I want to talk a little in detail about the new business segments, but before that, would we see your spreads improve as you raise rates going ahead? Are there more levers to improve your margins, your net interest margins as well?
So the point is, in vehicle finance, where we have a fixed rate book, there you would have seen that the NIMs have come down, whereas in the LAP and the HL and the other products, you would have seen the rates improve, primarily because these products had been repriced with regard to their existing book also. But in the mix of the vehicle finance, as we move on with newer disbursements happening at higher rates, these spreads would improve. So as the mix of the old product, that is a price increase products versus the post-price increase product changes, you will see NIM improvements happening. This is under the assumption that there are no further price increases by RBI and in the general market.
So, in terms of numbers, if you can help us with them, I think you're sitting at NIMs of around 7.8%. Is it fair to assume that as your new businesses grow, there could be some contraction in your NIMs in the initial few quarters and then expansion? I mean, what kind of a range are we looking at?
No, the new businesses are actually NIM accretive because their yields are higher. So they will show a higher NIM, but their OPEX will also be slightly higher. So you will see a trend where NIMs will improve, but you will also have situation of OPEX slightly going higher. But overall, as we always have maintained, our ROTA target would remain on a profit before tax ROTA of 3.5% plus. And I think that we stand committed to.
All right. And NIMs will be around 7%, 7.5% or?
Yes, actually, if you see over the cycles, we have always been in the 7+ range. The aberration actually had been the COVID years where we crossed the 8%.
Okay, so for us to maintain a broad number, we've got the AUM growth should be in the vicinity of around 7 to 7.5%, or would you want to give it at around 7.5%?
AUM growth or?
No, the NIMs. The AUM growth we have got, sir. We have got the AUM growth number. We just wanted some clarity on the NIMs number, if you could help us out. 7 to 7.5%?
Range of 7 to 7.5%. Yeah,
correct.
I think you should comfortably take it.
We have got that. All right. Sir, if you could give us a few more details. The asset quality has come in, at lower levels. Gross NPAs as well have reduced. Could you tell us how is the asset quality likely to look going ahead? Point number one. And point number two, the cost to income ratio, well, that's come in at its lowest in the last 5 quarters. But as you said, now you're looking at new businesses. So where do you see this number stabilize at?
So the asset quality, had, sort of deteriorated during the COVID too. And post that, quarter on quarter, we have been bringing it down and we have come to the pre-COVID levels. If no other new events happen, I think it will go through the same cycle as we used to have experience pre-COVID. That is, you will have the first half showing a slightly deteriorating or flattish or plateauing asset quality numbers, and then improvements in the second half, because these are quarters where the economic activities is slightly lower, and then in this third and fourth quarter, where especially since our focus is more on rural, etc., harvesting, etc., comes in play. So we will see the earning potential of the customers, strengthening in the third and fourth quarter, which will result in better asset quality. So you will come to those trend levels as we move on into a normal periods as we used to experience pre-COVID.
Mr. Selvan, just one point on auto. So we got monthly auto sales numbers, right? It's not exactly a very exciting picture out there overall. I mean, it's in two-wheelers, even four-wheelers for that matter. We got numbers for last month. But that's on one side. On the other side, there are many who expect that interest rates perhaps will be, some expect a full 100 basis point worth of rate cuts in the second half of this year by the Reserve Bank. About 55% of your borrowing comes from sort of banks. How is this going to play out if sales remain tepid on the vehicle side and interest rates come off a little bit? What will you be able to do in terms of margins, and how will you balance growth and margins?
See, the point of our diversification is to remove our dependence on vehicle finance as a portfolio, where it used to be, more than 75% plus. And I think that strategy will play out, and that's the point of, ability to build strength to ride cycles. So this will happen as we move on with other products also scaling up. So our dependence on vehicle finance as an overall product will come down. So I think we should be able to do this. And even within vehicle finance, we have all the product range covered. So it's not like, the car sale coming down or heavy commercial sales coming down would impact us. Yes, it will have an impact, but I think that's the strength of Chola, that we have diversified ourselves, progressively and in a very, structured way, that we are able to ride these cycles, and that's
Sure.
been, sort of, we have been experiencing that. On the interest rate
sir,
cut, I
just
don't see that.
yeah. Sure. Sorry,
go
just one follow-up on this vehicle financing, because you've tracked this space and you have your ear to the ground. There is some talk that in the commercial vehicle segment, there is a little bit of a slowdown that we are seeing, and the best of the upcycle is now behind us. Is that a fair assumption? I mean, you cater to the commercial vehicle segment, you cater to construction equipment as well. But in the CV space particularly, are you noticing signs of growth slowdown?
So the growth increase happened with regard to customer segments which are in the fleet operators. So we actually don't participate there. Actually, the growth which you are seeing here has happened without participating in that segment, and our focus has been more on the SRTO segment. And you have also seen that our used business has gone up in the vehicle finance. We have also scaled up on tractors, construction equipment and other parts of the vehicle finance business. So this has helped us to sustain the growth in this segment, and I think we have that ability to move from product to product to sustain this growth, what we are targeting to achieve. So we don't see any large scale challenges. Of course, we cannot be too far away from the industry. If the industry goes through a large degrowth, yes, we will also happen to, have to experience that.
Okay, we'll ask you the rate question next time you're on. We're out of time. Mr. Selvan, congratulations once again on a fantastic set of earnings. And as your, I think, earnings presentation says, 20% CAGR, right? I mean, so it's been an absolute rocker of a journey, and the stock's at a new high very handsomely in a market which is not doing all that much. Thank you very much. So that's Mr. Selvan at Chola Finance with detail. So 25 points, by the way, on the Nifty. We're at about, what, 18,113. I just want to take a quick look at a few stocks in the broader market. We've not addressed markets in the last 30-40 minutes. We've got ABB, which has moved up about 3.5%. M&M Finance is up about 3.25%, if you can have these up. GSFC is up about 3.5%. The oil marketing stocks, I think we mentioned at open. Bajaj Consumer is another one. Very large volumes, by the way, Bajaj Consumer. Stocks up 9% or so. I mentioned RVNL right before open. RVNL opened almost 10% higher, sold off 10%, and I think now it's down about, it's down 10-11% from the highs, the opening level. So 127, 128 on RVNL. Stocks basically doubled in the last 20-21 trading sessions now. GIC RE is another one, which is up about 6% or so. So lots of stuff out there moving around. Chola Holdings, by the way, is another one, the Murugappa Group company, sister concern, I mean, actually. 6%, 686 is where that one is, and that is jumping up as well. We'll take a quick break here. We'll be back. The management of SIS, the security services company, joins in to talk about their fourth quarter numbers. Stay tuned, coming up. Okay, welcome back. We've got the market, which is not doing much. It's still about 20-25 points higher. So, I mean, 18,100. Now, SIS, the security services company, reported numbers, and the earnings were good for the fourth quarter. Revenues and EBITDA saw good growth, although their margins contracted to below pre-COVID levels. Dheeraj Singh, Group Chief Operating Officer at SIS, is now joining in to take some questions. Thank you very much, Dheeraj, for joining us. Prashant this side. Could you, I mean, we're talking, I think, after a while, so could you talk to us a little bit about how the two main segments of your business are really doing at this point in time, and how are things looking for FY24 in both?
If we start with the overall PAT level, I think we've done phenomenally well. We've achieved 346 crores in the Q4, which translates to an annualized EPS of about 26 rupees per share, which in Q4 of FY22 was about 22 rupees. If you look at the growth, the India security business has grown 20% year on year, which is a phenomenal comeback. More importantly, the cash business and the facility management business have grown by more than 35% year on year basis. If you look at the Indian business, main business of security and facility management, the EBITDA, absolute EBITDA growth has been more than 28%. Even on the margin front, there's been improvement. Facility management was down in Q3 at about 4%. It's bounced back to 4.4%. And the security business continues to inch upward, even in the margin percentage, from 4.9 to 5%. But I'd like to point out on the cash, because that's our business is all about cash flow. And we've done very well on that front. In Q4, our OCF to EBITDA is about 145%, which was about 95% only in the previous corresponding Q4. We brought down our net debt the last time that our goal is to bring the net debt down. It was 2.1, the net debt to EBITDA ratio. We brought it down to about 1.75. And just this week, we repaid another 82, which brings it down to about
Mr. Singh, yeah, we do have those numbers. Actually, we're trying to get some, forward-looking statements. So just some indication of what the future could look like. In your facility management business, which is, I think, about 20% of your revenues, where you do housekeeping, cleaning, facility operations, etc., it's been pretty good. The growth has been strong, 35% plus revenue growth. Is that something that is sustainable over the next couple of quarters and in FY24?
Yes, for this current year, we expect the similar growth patterns to continue. But our focus will be on improving the EBITDA line far more than the top line also for facility management.
All right. And also on the debt, I think you were mentioning the reduction in debt. It's about 860 crores right now. How much do you think you can bring it down by further in FY24?
Well, it's less than 800 crores now. I was mentioning this week itself, we've repaid another 82 crores to National Australia Bank. So it's below 800 crores, and we are watching the situation. Every quarter, we intend to repay a little more.
So by the end of this year, Mr. Singh, what can the number look like from the sub 800 crores?
See, globally, as we've discussed in the past, we like to operate in the 1.5 to 2 debt ratio.
Okay.
So we'd like to keep it in that range. Probably a little below 1.5 is where it would be ideal.
Okay, let's look for a couple of more numbers. Then the revenue growth, what can you guide for the entity on the whole? And also margins, well, it's been between 4.5% to around 5%. What's the outlook on both these two?
On the margin front, our goal is to reach pre-COVID levels at the earliest for India business, which is in the 5.5% to 6%. Our projections for this year seems to be on track to achieve that within this year itself, and definitely in the Q4 of the current FY. On the growth side, we see no issues at all. Growth is very, very robust on both security as well as on the facility management side. I'd like to point out our cash business also, which has clocked the highest revenue this year of 540 crores. And that's operating at a 16% EBITDA margin also. So growth on all businesses is very, very intact. Our focus is on improving the EBITDA margin to pre-COVID level.
Okay, all the best for that, and thanks a lot for joining us on CNBC TV18. That's SIS India, the management talking about the business and the way forward. For the market, actually, it's a very quiet, really flat day. The Nifty is in the green, but not building onto its gains too much. So let's do one thing. Let's take a quick break. On the other side of the break, Mitesh Thakkar will join in for some technical trades. Stay tuned. Okay, well, this market is not moving anywhere, but individual stocks are. ABB is actually one of the big stocks that's moving right now. 4% higher posted numbers. Mitesh Thakkar is here to give us more details on what to expect. Mitesh, you know, these boys that are moving because of good numbers, whether it's Chola, ABB, Titan, what are your thoughts here? And then, of course, we'll move to your own stocks.
So, in fact, ABB is my recommendation list as well. But, you know, broadly, if I were to cover Titan first, that's a stock, you know, which has been going through an uptrend for many weeks now, and I think it's heading towards the highest weekly closing, which the stock did about 27.74.75. Around those levels, you might see some profit booking. ABB, as I mentioned, is on my buy list already. That's a buy with a stop at about 35.50 for targets of 37.20. And PFC is the other recommendation, which I would recommend buying with a stop below levels of 170 for targets of 182.
And okay, all right. Thanks a lot for that. Appreciate your thoughts. So PFC is also on his list, and ABB, despite the 4% rally, is something that Mitesh definitely likes. But so many stocks that are buzzing on the back of news as well. So let's get straight to that. Sonal is here with us to talk about Petronet LNG. Sonal, why are you watching that one?
Well, weak set of numbers, and that's what we are able to see in the stock price as well. It was expected to be a good quarter, but that's not the case. And that's why this big disappointment that has come by as well. Revenues, they were down 12% sequentially, lower than the poll as well, coming in at 13,874 crore rupees. The EBITDA was lower at 940 crore rupees versus a poll of around 1,078 crore rupees. Margins lower by 200 basis points versus the poll at 6.7%, and profits also at 614 crore rupees. It was led by lower volumes in both Dahej and Kochi terminals. So Dahej volumes were up 11% sequentially versus an expectation of 13 to 14% increase. Utilization, however, was higher on a quarter-on-quarter basis. Kochi volumes were flat on a sequential basis. Utilization was at 8%, lower than what the street was working with. In fact, FY23 performance was the weakest that the company has seen in last 4 years because of higher spot LNG prices. Jeffrey says that In April, the Dahej utilization, it has increased to levels of 97%. That's a positive. Volumes are higher as well. And the lack of surprises on capex also is comforting. They have big cash in their books, but capital allocation has been a big worry for Petronet LNG. But unless they finalize one of their PDHPP project, that could be a key overhang on the stock, and that is what they are watching out for. Motilal Oswal says that despite near-term improvement in volumes that the company is talking about, long-term volume growth prospects remain very bleak for the company, and they are seeing intensifying competition from new LNG terminals as well as increasing domestic gas supply, which will reduce imports and ultimately their utilization. That's why they have a neutral rating on the stock.
Okay, Sonal, thanks very much. Bajaj Consumer has been jumping. The stock is doing very well. Mangalam is here to tell us why. Mangalam.
That's correct. You know, good numbers coming in post-markets yesterday. 14% jump in the company's revenue. The EBITDA jumps by 20%. That means a margin expansion of almost 80 basis points. And as a result of which, the net profit also seeing a double-digit growth. The important part is that the margins have expanded despite gross margins coming off. So that's telling you that operating leverage is playing out. And secondly, the growth has been led by modern trade and e-commerce channels. And that's been the company's focus. So modern trade and e-commerce have grown between 42 and 63%, of course, on a low base, but that's where the company's growth focus is. The volume growth of the company has been around 10% in the fourth quarter, and while Bajaj hair oil market share remains flat at 10.4%, the growth this year has been led by all their new products, and that again is a big positive. The new products have grown by 2.5 times in FY23. So what are the big triggers that we're watching out for? Almond Drops hair oil, which is their key product, is regaining traction, is what the company says. Launches beyond Almond Drops hair oil have been planned in FY24, so they're extending the brand there. The third part is that their non-almond drop portfolio, which is coconut and amla, doing extremely well. That's what's led growth. And finally, the company is building digital first brands, so putting their money where there is fair amount of growth. For all of this, what are you paying for Bajaj Consumer? Trading at just around 14 times FY24 price to earnings, which is much cheaper as compared to all the other FMCG stocks on the block.
Okay, Mangalam, thanks a lot for